Let's dive right into today's explainer, where we're unraveling a massive financial mystery unfolding right now in the US housing market. We're looking at a fascinating story where macroeconomic shifts are colliding head-on with human psychology. And honestly, it reveals something truly wild about how we handle our money. Because what makes this so compelling is that we're looking at a scenario where millions of people are essentially throwing away billions of dollars voluntarily, and they're doing it with a smile on their faces. To set the stage, a report by the Republican Policy Committee neutrally outlines our current macroeconomic reality, which is that the cost of borrowing has fundamentally shifted. 30-year fixed mortgage rates have absolutely skyrocketed, going from a historic low of 2.65% in early 2021 to hovering near 7% today. That is the steepest climb we've seen in decades, and it represents a massive, foundational change in how much it actually costs to access capital in America. To put that steep climb into perspective, the RPC report notes exactly what this means for a typical homebuyer. The monthly cost for a standard $400,000 loan more than doubled, jumping from $1,612 at those early 2021 rates to $3,291 at recent peak rates. This matters deeply, right? It creates a historic housing affordability crunch. It's a massive barrier to entry that is pricing younger generations out of the market, while at the exact same time, it's trapping older generations in their current homes because giving up their old, cheap loan would just be way too expensive. Section 1, a bizarre financial paradox. The crucial point here is that those lucky homeowners holding older mortgages locked in at around 3% possess a golden asset. They hold incredibly cheap debt in an environment where everything else is shockingly expensive. For most of them, this is literally the cheapest money they will ever borrow in their entire lives. Which brings us to a highly unexpected twist in the data. According to a fascinating recent academic paper analyzing consumer credit records, homeowners holding these low-rate mortgages have voluntarily lost $4.6 billion in net present value between early 2022 and late 2024. Just to quickly unpack that, net present value is basically a way of calculating what future money is worth today, accounting for interest. By actively paying off these cheap loans early instead of investing their extra cash, homeowners have effectively forfeited billions. Let that sink in for a second. $4.6 billion. Now you might be wondering, and this naturally baffles economists too, why would people voluntarily throw away billions of dollars when they hold such incredibly cheap debt? I mean, in a strict financial sense, holding on to a 3% mortgage is practically a license to print money if you just take your extra cash and invest it elsewhere. So why give up free money? What is actually going on behind closed doors here? Well, the answer lies in something the mortgage industry calls curtailment. Curtailment simply means voluntarily paying more than your required minimum monthly mortgage payment. It's when borrowers send a little extra cash to their lenders every month to pay down their principal balance faster. Ultimately, this reduces the amount of interest you owe over the life of the loan and shortens the timeline until the house is totally paid off. And what the researchers found about this behavior is honestly staggering. Even when these homeowners could easily earn a much higher return by taking that same extra cash and literally just parking it in a zero-risk, high-yield savings account or a government treasury that guarantees a 5% yield, a massive 22% of households with these negative rate spreads still choose to prepay their mortgages. Section 2, the compound interest math. Let's actually look at the math and see how this builds. Because standard portfolio theory dictates that these homeowners should be doing something completely different with their extra cash. As highlighted by the financial education platform Financial Mentor, utilizing extra cash to leverage compound interest is vastly superior to paying off cheap debt. They call compound interest the most powerful concept in finance, and for very good reason. It's the mechanism of money making money, snowballing over time into massive wealth. But unfortunately, prepaying a cheap mortgage stops that snowball dead in its tracks. And this brilliantly illustrates the mathematical mistake these homeowners are making. Think about it. If your mortgage costs you 3% in interest to borrow, but a virtually risk-free treasury bond yields 5% if you save, taking your extra cash to prepay the mortgage actually results in a negative net present value. You are quite literally paying your lender for the privilege of missing out on a higher return. You're handing them money that could be working for you. When we crunch the numbers through a calculator at Financial Mentor, the sheer power of investing that extra money instead becomes overwhelmingly obvious. If you take a $25,000 base and simply invest those $500 monthly additions at a 7% return, it grows to over $230,000 in just 15 years. The trajectory of this curve is exactly what prepayers are just giving up. Now, what's truly fascinating is the breakdown of that growth. Notice how, over those 15 years, the total interest earned actually outpaces the initial investment and all your monthly contributions combined. This is the staggering opportunity cost that prepaying homeowners are entirely missing out on. They are completely forfeiting the biggest piece of the pie here. Yet, completely ignoring this lucrative math, the academic study found that the average prepaying household with a negative rate spread is still dumping $556 of extra cash into their low-interest mortgage every single month. By doing this, they're actively choosing to lose about 15% of the value of each extra dollar paid, relative to what they'd have if they just invested it. It's just an astronomical monthly leak of household wealth. Section 3, the psychology of debt aversion. Okay, so if the math is so overwhelmingly clear, we need to dive into the behavioral economics to solve this mystery. Why are incredibly smart people making a mathematically bad choice? To understand this, we have to move from the spreadsheet to the human brain. The academic researchers point directly to popular personal finance advice to explain this deep-seated behavior. They quote Dave Ramsey, who famously states, "The borrower is slave to the lender." This illustrates a very deep cultural belief in the U.S. that ridding oneself of debt isn't just about spreadsheets. It is a moral imperative. It's tied to the American ideal of freedom and independence. Debt is often viewed as a heavy chain, and spreadsheets simply don't account for how that chain makes people feel when they're staring at the ceiling trying to sleep at night. This phenomenon is known in behavioral economics as debt aversion. It's where the emotional desire to be completely debt-free completely overpowers rational portfolio math. People aren't maximizing their financial returns, they are maximizing their peace of mind. The psychological weight of owing money to a bank is just heavier to them than the joy of earning compound interest on a treasury bond. Ironically, the data breaks the assumption that these people are just financially illiterate. Actually, scratch that. It's quite the opposite. The typical prepayer is remarkably responsible. They boast high credit scores, often around 800. They carry little to no credit card debt. They tend to choose shorter auto loan terms right out of the gate, and they are highly likely to prepay those auto loans too. They simply hate being in debt, and they treat all debt as an enemy to be vanquished, even when some debt is mathematically advantageous. And this behavior gets even more extreme as the finish line comes into view. The researchers found that as borrowers get within $500 of their final mortgage principal balance, the likelihood of them prepaying spikes from that baseline of 22% to nearly 50%. Rationality goes completely out the window. The psychological thrill of hitting zero on that loan balance completely overrides any logical thoughts about treasury yields or maximizing returns. To further prove this point, the researchers demonstrated that while consumers completely ignore the long-term math of interest rate spreads, they react instantly to short-term cash flow changes. Picture a family receiving a stimulus check. Instead of logically investing that windfall for future gains, they immediately dump it into the mortgage to feel relief today. The same happens when adjustable rate mortgage payments reset higher. They quickly try to pay it down. They don't react to abstract present value, they react emotionally to the actual dollars in their pocket today. Section 4, the ultimate clash, math versus emotion. What we have here is a massive collision between a macroeconomic environment, which practically begs people to hold on to their incredibly cheap debt, and the micro-level psychology of individual households who just desperately want the bank off their backs forever. Which leaves us with this final thought for you to get away from this explainer. We've seen the $4.6 billion price tag of peace of mind. But faced with these numbers in your own life, what would you do? Would you choose the logical maximum return or the emotional peace of finally being debt-free? It's a powerful question where the spreadsheet and the human heart give two very, very different answers.